My name is Ken Solow. I'm the Chief Investment Officer of Pinnacle Advisory Group. And this presentation is called, Is This a Reasonable Time to Take Risks? I think it's an interesting title because it suggests there are times where it's unreasonable to take risk, which is clearly not the industry status quo where we're always supposed to be taking risks. And I think you could expand this to ask the question, are all risks reasonable? And so we're going to kind of attack both of those questions in this presentation today. I'm in a unique position in my role at Pinnacle as Chief Investment Officer, while Rick Villaro, our Chief Investment Strategist, is in charge of executing our strategy here on a day-to-day basis. It's my job to oversee our investment strategies and make sure that they remain state-of-the-art and that they remain viable in today's volatile and dangerous markets. An interesting time right now for us to evaluate Pinnacle's risk-taking, and that this October will be the 10-year anniversary of our what's called GIPS compliant track record, our official track record in managing active and tactical strategies. And 10 years is an important time frame because we're presumed to manage money over complete market cycles over that period of time, which is of course very useful to evaluate, and we'll do some of that in this presentation today. It's also important that we have the same analysts working today that we did back in October of 2002 when we began reporting in this fashion. So we get to see how did this analyst team do over that complete time horizon and through various market cycles. So with that, let's dive in. What I'm showing here is our dynamic moderate growth portfolio return, and it's on a slide showing two scales. On the vertical scale is percentage reward or annualized returns, and on the bottom scale is percentages of risk or standard deviation. And as we orient this return in space here, the first way we might look at returns is in terms of absolute return, which is simply to say, is a 7% annualized return over the last 10 years, is that sufficient to get you to your financial goals and objectives? At Pinnacle Advisory Group, we have wealth managers to work with our clients in finding out this delicate dance between portfolio returns, savings, your life expectancy, your retirement plans, your levels of spending. So it's very much a unique and individual financial planning question as you evaluate absolute returns. But of course, in the investment team, we need to look at this perhaps relative to some other benchmarks. So here I give you three potential benchmarks to compare to. We have cash, bonds, and stocks. Obviously, our portfolio result has the highest return over this nearly 10-year period, which is excellent. And then quite intuitively, our portfolio took more risk than either cash or bonds and significantly less risk than stocks. Now, it is somewhat troublesome that all of us tend to always compare the portfolio to the best performing benchmark, which can be rather frustrating. So in bull markets, we tend to compare to stocks, and a balanced portfolio typically would underperform. In a bear market, we would tend to compare to bonds or cash. We would tend to underperform. So in order to kind of eliminate this somewhat unfortunate circumstance where we're always underperforming with a balanced portfolio, the best thing we can do is suggest a blended benchmark. And here we're showing the benchmark for our dynamic moderate growth strategy, which is a 60% mix of S&P 500 index and 40% of the Barclays Aggregate Bond Index, which leads us to some interesting discussions we should have about the notion of benchmarks in general. So this then is a benchmark portfolio, and one of the things we should understand is at Pinnacle Advisory Group, every one of our strategies has a benchmark, which uniquely at Pinnacle is a risk benchmark. So our most conservative strategy is benchmarked to 20% in equity. Our conservative growth portfolio is 45% in equity. Our moderate portfolio is 60% equity. Our dynamic appreciation is 75% equity, and our ultra appreciation is 100% equity. But those benchmarks are not targets for our asset allocation. They're targets for the range of risk or volatility we're allowed to take. We actually take the benchmark portfolio and back test it, in our case, all the way back to the 1970s. And we present our clients a great deal of information about the volatility and return of these portfolios. So when our clients come on board, they sign a policy statement that actually establishes the range of volatility for any one of our strategies. Now, what's interesting is, of course, we don't actually own the benchmark, or as tactical and active money managers, we're allowed to deviate with the amount of risk in our benchmark. So when we don't have a clear forecast of future markets, when we have low conviction in what the news may be, or low conviction in our forecast, we are going to own ranges of risk that are very much at benchmark or neutral levels of risk. It's only when we get to higher levels of conviction that we begin to move off the benchmark to either a more bullish or a more bearish portfolio construction. As we do that, that will let our portfolio fall on this chart into 4 different places. The first quadrant is the upper left, where we have lower risk and higher return than the benchmark. The next is lower risk, lower reward than the benchmark. The next is higher risk, higher reward than the benchmark. And finally, higher risk and lower reward than the benchmark. Now, I like to look at this a slightly different way. In this view, I call landing in this quadrant career risk. If a money manager is persistently, over time, taking more risk than their benchmark and delivering lower returns, I think we could all agree that their engagement with clients is going to tend to be much shorter term in nature. In the upper left-hand quadrant, or what's known as the northwest quadrant of portfolio performance, I like to call this a pleasant fantasy. Again, this is a very counterintuitive place for returns to be, where you're delivering consistently higher returns with less risk than the benchmark. It's these last 2 quadrants that I like to call the most intuitive place for portfolio results to end up on this chart. In the lower left, we can easily have lower returns and lower risk than the benchmark by simply adding cash to the portfolio. And by borrowing money and just buying more of the benchmark, we can end up in the upper right-hand side, where we're delivering higher returns with higher risk. The question is, if you're in these intuitive areas, how do you know whether or not the portfolio returns are good or bad? And fortunately, modern portfolio theory gives us an answer, and it's called the capital asset pricing model. So in CAPM, essentially we take the beta, or the relative volatility of our portfolio, and compare it to the benchmark, and the model gives us a value for what the portfolio ought to be. So if on a risk-adjusted basis we're outperforming the model, we get to say we have positive alpha in the portfolio. And if we're underperforming the model on a risk-adjusted basis, then if we underperform, we have negative alpha. And money managers the world over for the past 40 years have been chasing positive alpha just as fast as they can. So we've introduced 3 ways of looking at returns and risk. The first is absolute return, the second is relative return, and now we're looking at risk-adjusted returns. Now, there's an important point to be made about risk-adjusted returns. Let's look at this chart, and I offer you 2 different portfolios compared to a benchmark. The one on the lower right obviously is taking significantly less risk than our benchmark, but has delivered less returns, yet it has positive alpha, that holy grail for money managers. The portfolio on the upper right has taken dramatically more risk than the portfolio, yet it has negative alpha. The money managers have been very inefficient in generating the returns. The question is, which portfolio would you choose? And surprisingly for many, the answer is the one with negative alpha, because once the returns are booked, the risk effectively doesn't matter. We now know which manager was correct in their assessment of risk. It's whichever manager has the highest return. So as we look at track records and we look at 1 month, 1 year, 3 year, 5 year from inception numbers, it's important for us to keep in mind that we can't just look at risk and return. We have to look at investment process, because in the rear view mirror, we can't really understand or appreciate why it is that a manager took risk or did not take risk. very important to evaluate process in that regard. The last issue we need to understand as we do our analysis is that when we compare to a benchmark, we can actually move our portfolio result around this grid without ever changing the portfolio itself at all. We can do it by changing the benchmark. So we need to evaluate how we've constructed a benchmark so we can best evaluate our relative performance. At Pinnacle, we've chosen a 2 asset class benchmark, which has several advantages and disadvantages. The advantages of a 2 asset class benchmark are, number 1, it's simple. Number 2, that these are the securities that prospects for Pinnacle Advisory Group typically own in their portfolio. Most investors are still very much US-centric in what they own. And then finally, this is how most investors think about risk. And while I might long for the day when investors come in and ask us about the yen-euro cross, it turns out most of the time they're very much thinking about what just happened with the Dow Jones Industrial Average. So these are 3 powerful reasons to have a 2 asset class benchmark, and at Pinnacle that's what we do offer, but a 2 asset class benchmark has some drawbacks we should keep in mind. First, when you have a 2 asset class benchmark, it discourages diversification. Low correlations work against you, and what that means is if we build a portfolio that's diversified, which is very important to us at Pinnacle, where instead of just owning the S&P 500 index, which is the only risk proxy in our benchmark, so if instead of just owning the S&P, we were to own commodities or real estate or small cap stocks or international stocks, and they were to zig and zag at a different time than the S&P, specifically if they were to zag, meaning they were to lose money relative to the S&P, then even though we've built a sound portfolio in terms of relative risk management, our returns are not going to look good. So at a time where US large caps are beating commodities, are beating international stocks, which is in fact the market environment we've found ourselves in for the past year or two, then it's going to be very tough to beat the benchmark because US large cap stocks are leading, and that is the one risk proxy in the benchmark. So now we can take a look at Pinnacle portfolio performance from inception, and as you can see, for the portfolios that are risk-taking portfolios, we've done remarkably well over this 10-year period or near 10-year period. Notice that the DUA portfolio, our ultra appreciation portfolio, is firmly in the northwest quadrant. Our DA portfolio in gold, again, firmly to the northwest quadrant compared to its benchmark of 75% equity. And the moderate growth, again, firmly to the northwest quadrant. Again, that's that pleasant fantasy quadrant, very counterintuitive, exactly what institutional investors are trying to accomplish. On the conservative growth and conservative portfolios, those returns are more intuitive as we've developed slightly lower returns in case of conservative growth with less risk, and then a very intuitive dynamic conservative result, again, lower risk, where we've delivered positive alpha in every one of our portfolios. So having looked from inception, I think next we need to break this down so we look at it over market cycles. On this chart, we're going to look at bull markets and bear markets from 2002 through 2012. We start out with a bull market that begins in October of 2002 and actually lasts for 5 full years and ends in October of 2007. It's followed by a dramatic bear market that goes from October of 2007 through March of 2009, followed by another bull market. The market almost doubles and ends in April of last year. Then we had a shallow bear market. The market declined by 19.5% through October, and the market's been rallying ever since. So for the purpose of our analysis, we're going to simplify that last market period as one bull market, just so that it makes the animations we're about to look at a little bit easier to see. So we're going to show you the first bull market and just focus on that period where the triangle is the Pinnacle portfolio and the X is our DMG benchmark. Again, 60% equities and 40% fixed income. Now you can see in the upper right the months rolling by as we go month to month through this 5-year period. And as the animation ends, you can see that the portfolio is squarely outperforming the benchmark and taking more risk. So you can see that we would conclude from this 5-year, fairly long bull market within a secular bear, Pinnacle analysts must be what I call steely-eyed risk takers, as they push the pedal to the metal, taking more risk than the benchmark and driving higher returns. If we look at this other than relatively, the two other ways to look, as you recall, one is the absolute returns look very nice. The annual return for the portfolio was 11.2%, much higher actually than our target for the moderate benchmark, which is usually 8% is our assumption. And as you can see, versus both the benchmark and the S&P 500 index, we developed very positive alpha numbers. So on a risk-adjusted basis, we also did well. Let's take a look then at the bear market from October of 07. So here again, you can see time scrolling by. We finished this period with significantly higher returns and significantly less risk. Here we are in pleasant fantasy land, delivering exactly what our financial analysts are trained to deliver. But an interesting observation on this chart is what happens when we look at the absolute returns. Now the annualized return for the portfolio is a minus 18.61%. So even though when we're comparing to the benchmark, we did a fantastic job, obviously in terms of people's financial planning goals and objectives, a disappointing time frame. When we look at the alpha or risk-adjusted basis, there's enormous alpha. We did very well on a risk-adjusted return basis in bear markets. Let's look at the next bull market. So now we're watching the animation play out as we play through the current period through January of 2012. And now, interestingly, on a relative basis, portfolio performance has fallen to the southwest quadrant. We've earned lower returns with lower risk, a very intuitive return. Let's see how we did on both an absolute and risk-adjusted basis. So here, just the opposite of the previous period, clients are thrilled. The partners here at Pinnacle are jumping for joy. We're generating 21% annual returns for this portfolio, more than double what we would have projected, with very nice positive alpha versus the S&P and even during our benchmark. But from my perspective, the question really is, how did the same group of analysts who outperformed the benchmark by taking more risk in the first 5-year bull market we looked at, how did they underperform this time around? What's different? What market circumstances would cause our portfolio result to fall from the northwest quadrant down to the southwest quadrant? You may remember this chart, which is our market cycle chart that we evaluated earlier. I think we can find the answer to our question right here. Our approach to risk-taking necessarily has changed since the Lehman bankruptcy. And I think it's worth discussing just what it is that's changed in the marketplace and in our philosophy of money management. There's different types of risk that our investment process is designed to deal with as we're making forecasts and tactically and actively managing portfolios for our clients. The first type of risk we deal with is business cycle risk. And as you'll see, there is plenty of data for us to use historically to make sound, I think, very sound investment decisions based on the data we see about the business cycle. Structural risk is different. Structural risk are longer-term risks like inflation risks or risks of debt. And while it is true that we're coming to the end of a 40-year debt supercycle and that the amount of debt globally is very high and that we're probably in for a significant period of deleveraging, as it turns out, we have many periods of deleveraging, many periods of too much debt. There are many banking panics for us to evaluate, many periods of inflation and deflation. So our process does very well in terms of structural risks as well. But today we're dealing with a different type of risk. It's systemic risk or risk to the financial system. And in our view, when you look at system risk, the overwhelming consideration now is the advent of derivative securities, these very highly leveraged, interlocking securities that are very hard to quantify in terms of the amount of risk they add to the financial system. Warren Buffett describes derivatives as financial weapons of mass destruction, and we certainly agree. In the post-Lehman Brothers environment, every time we've had a dip in the market, we've looked over that precipice and had to decide whether or not the decisions that would get made, especially the policy decisions that are being made, whether they would lead to the type of a policy mistake that would lead to very, very large market declines. And have experienced two of them over the last decade, we think it's important to keep that in mind as we determine what is reasonable risk. Our investment process is designed to find value in a complicated world, and we do that in three ways. One is to evaluate the business cycle. Another is through technical analysis, or just evaluating the behavior of investors. And finally, through traditional fundamental techniques for valuing markets. But what our process is not designed to do is to evaluate unprecedented government intervention in the markets. When you consider what's gone on recently in Europe, what's gone on recently in the United States, we've had several trillions of dollars of liquidity injected into the financial system in a way that is unprecedented. And you can make a strong argument for the bullish case that this liquidity will leak into the risk markets, driving assets higher. But you can also make a strong case that this liquidity is not what's necessary to solve what's essentially an insolvency problem. And as investors lose confidence in government's ability to resolve this, financial markets would fall dramatically. So, some observations about the situation. We are in the middle of an ongoing systemic crisis in Europe. We're seeing the second tranche of the LTRO, or the long-term refinancing operations, from the European Central Bank just this week. Last week, we saw the outcome of the second bailout for Greece, certainly not the last. So we know that this notion of systemic risk is not some philosophical discussion, but a very real and ongoing problem in investing. We also know that it's very possible to win very big, making big bets and positive outcomes in these types of circumstances. The problem, of course, is also possible to lose big. So last year, where the average hedge fund lost 5%, John Paulson, a very well-known hedge fund manager, lost 45% in his hedge fund. John Corzine went out of business last year with MF Global. Lots of risk for money managers in investing in this year, in this market climate. And we simply don't believe that it's an investment anymore. To make a big bet in this climate is much more of a speculation, and we simply won't do that with client money. It's impossible to forecast the outcomes of this based on past data. That is what makes it a speculation as opposed to an investment. And it's difficult to get enthusiastically bullish on a relative return basis. As we've seen, we are more than capable of driving returns for clients in these bull markets that, even though they may be bubble-driven or liquidity-driven, we can still drive returns that are far greater than what we would have expected on an absolute return basis. However, on a relative basis, very, very difficult to be making decisions to take us up to that upper right-hand quadrant. And finally, it is problematic to beat a two asset class benchmark in this market environment. And we are in an environment where international stocks and commodities are significantly trailing the U.S. market. Investors are running to the U.S. as an island of safety. And while we are willing to concentrate our portfolios to a certain degree, we're not willing to abandon our basic core belief that we should have a diversified portfolio. So, to summarize, we'll continue to take risk when we think it's reasonable to do so. We'll continue to not take risk when we think it's unreasonable to do so. Thank you.